On February 5th, 2026, outplacement firm challenger Gray and Christmas released employment data that should alarm every working American. In January alone, U.S. employers announced 108,435 job cuts. That is a 118% increase compared to January 2025. It's also 205% higher than the 35,553 layoffs announced in December. And here's the kicker. It's the highest January layoff total since 2009, during the depths of the Great Recession. Let me repeat that. The worst start to a year for job cuts in 17 years. But wait, how can layoffs be surging when the economy is supposedly booming? The third quarter of 2025 saw GDP growth of 4.4% annualized. That beat forecasts. Stock markets are near all-time highs. Corporate profits are strong. Manufacturing indexes are expanding. Every headline economic indicator says the economy is thriving. So why are over 100,000 Americans losing their jobs in a single month? This contradiction caught the attention of Mohamed El-Erian, chief economic advisor at Allianz and professor at Wharton. He called the data sobering. His exact words were, "This speaks to the decoupling of employment from economic growth, and if it persists, has profound economic, political, and social implications." And he's deeply worried about what happens next. Historically, when GDP grows at 4.4%, companies are hiring aggressively. Unemployment falls, wages rise. The benefits of economic growth spread across the labor market. That's how it's supposed to work. But in 2026, GDP is growing while layoffs are accelerating. Companies are posting record profits while cutting headcount. The stock market is soaring while workers are getting pink slips. This isn't just a statistical anomaly. This is a fundamental restructuring of how the economy operates. And if you're a worker, not a shareholder, you're on the losing side of this transformation. The economy is decoupling from employment. Growth no longer creates jobs, and that changes everything. To understand how unprecedented this moment is, we need to compare it to 2009. January 2009 was one of the darkest months in American economic history. The financial crisis was in full swing. Lehman Brothers had collapsed. The housing market was in ruins. Credit markets were frozen. And employers announced over 240,000 layoffs in January 2009 alone. That was catastrophic. But here's the critical difference. In January 2009, the economy was in freefall. GDP contracted sharply. The stock market had crashed. Consumer spending collapsed. Business investment evaporated. It was a recession. A brutal, devastating recession that would eventually be called the Great Recession. The layoffs made sense in that context. When the economy shrinks, companies cut jobs to survive. That's how recessions work. But January 2026 is completely different. We just posted 4.4% GDP growth in the third quarter of 2025. The S&P 500 crossed 7,000 for the first time in history just last week. Corporate profits are at or near record levels. Consumer spending, while weakening, is still positive. This is not a recession, at least not by the traditional definition. And yet, we're seeing 108,135 layoffs in a single month. That's not Great Recession levels, but it's the highest January since the Great Recession. We're experiencing mass job cuts during a period of economic expansion. That's not supposed to happen. In every previous economic cycle, growth meant jobs. When GDP rose, unemployment fell. The two moved in opposite directions. That's the basic economic model that's held true for decades. But that relationship is breaking. We're in uncharted territory. An economy that grows without creating jobs. An economy where corporate profits surge while workers get fired. An economy where the stock market hits all-time highs while families lose their livelihoods. This isn't a recession. It's something worse. It's a jobless expansion. Economic growth that benefits capital, not labor. Shareholders win, workers lose, and the political and social consequences of that divide are going to be explosive. If 2009 was a crisis of collapsing growth, 2026 is a crisis of growth that doesn't matter to ordinary people, and nobody knows how to fix it. The layoff numbers are bad enough, but the hiring data is even worse. In January 2026, U.S. employers announced plans to hire just 5,306 workers. That's the lowest January hiring total since Challenger, Gray, and Christmas began tracking this data in 2009. Let me put that in perspective. In December 2025, just 1 month earlier, companies announced plans to hire 10,612 workers. That means January hiring plans dropped 50% in a single month. Year over year, hiring plans are down 13% compared to January 2025. But here's what should terrify you. These hiring plans were set at the end of 2025. Companies look ahead at the coming year and decide how many people they'll need. And at the end of 2025, looking forward into 2026, employers collectively said, we're only hiring 5,306 people nationwide in January. That's not companies reacting to a sudden crisis. That's companies deliberately choosing not to hire. And it gets worse. Challenger, Gray and Christmas surveyed employers about their expectations for the rest of 2026. 52% of companies expect to announce more layoffs this year, more than half. Think about what that means. We just had the worst January for layoffs since 2009. And a majority of companies say they are planning even more cuts. This isn't a one-month blip. This is a trend. Andrew Challenger, the senior vice president of the firm, said it plainly. These plans were set at the end of 2025, indicating that employers are less than optimistic about 2026. Less than optimistic is corporate speak for terrified. Companies are bracing for a bad year. They're cutting costs. They're freezing hiring. They're preparing for a downturn even though GDP is growing at 4.4%. Why? Because they don't believe the growth is sustainable. They see the same contradictions we're talking about. Consumer confidence collapsing, manufacturing expanding but firing workers, stock markets hitting records while Main Street suffers. Smart executives know this can't last, so they are protecting their balance sheets, cutting headcount, hoarding cash, waiting for the other shoe to drop. The no hire, no fire economy we talked about in our manufacturing video, that's officially over. The no fire part just ended. Companies are firing. They're just not hiring to replace those workers, and 52% of them plan to keep firing throughout 2026. So which industries are driving these massive layoffs? Let's break down the carnage by sector. The transportation industry led the way with 31,243 announced job cuts in January. That's nearly a third of all layoffs. And the reason is simple. UPS, the logistics giant, is executing its plan to eliminate 30,000 operational jobs throughout 2026. Why? Because Amazon ended its contract with UPS and brought package delivery in-house. Amazon built its own logistics network, its own planes, its own trucks, its own delivery drivers. And now UPS, which relied heavily on Amazon's business, has 30,000 workers it doesn't need anymore. Those jobs aren't coming back. Technology came in second with 22,291 layoffs. Amazon itself announced 16,000 job cuts in January as part of what it called a restructuring to remove management layers. But let's be honest, this is Amazon eliminating middle management and replacing them with AI systems. Fewer managers, more algorithms. The same work gets done with a fraction of the headcount. Healthcare was third with 17,107 announced layoffs. That's the highest for the healthcare sector since April 2020, during the peak of the pandemic. And we covered the reason in our previous videos. Medicare Advantage reimbursement rates for 2027 came in at just 0.09%, crushing health insurers like United Health and Humana. When revenue disappears, jobs follow. But here's what's disturbing. These aren't struggling industries. Transportation, technology, and healthcare are three of the largest, most profitable sectors in the American economy. UPS isn't going bankrupt. Amazon isn't failing. Healthcare companies aren't shutting down. They're all making money. They're just making that money with fewer people. And the reasons for the cuts tell the story. The number one reason cited for January layoffs was contract loss. That accounted for 30,184 cuts. Now let's talk about the elephant in the room, artificial intelligence. In January 2026 alone, employers cited AI as the reason for 7,624 layoffs. That might not sound like a huge number compared to the 18,435 total. But consider this. Challenger, Gray, and Christmas only started tracking AI-related layoffs in 2023. In all of 2025, AI was cited for 54,836 layoffs. That's 10 times higher than 2024. And January 2026 is already tracking at a pace that would shatter last year's record. Since tracking began in 2023, AI has been explicitly cited as the reason for 79,449 job cuts. And that's just the ones companies are willing to admit. Andrew Challenger from the firm said, "It's difficult to say how big an impact AI is truly having on job cuts. Many companies don't explicitly cite AI when they announce layoffs. They'll say restructuring, or efficiency gains, or organizational changes. But behind the scenes, they're implementing AI systems that make human workers redundant. Amazon is the perfect example. The company announced 16,000 layoffs in January. The official reason? Removing management layers to flatten the organization. But what's really happening? Amazon is using AI to automate decision-making that used to require middle managers. Inventory forecasting, logistics optimization, workforce scheduling, pricing algorithms. All of that used to require teams of analysts and managers. Now it's handled by machine learning models. The managers are gone. The work still gets done. And here's the insidious part. The market rewards companies for this. When a company announces layoffs and mentions AI in the same breath, the stock price often goes up. Wall Street sees it as innovation, efficiency, modernization. Investors cheer. Executives get bonuses, and workers get pink slips. The 7,624 number is just the tip of the iceberg. It's the companies honest enough or proud enough to explicitly say, we're firing people because AI can do their jobs better. But for every company that admits it, there are dozens more doing the same thing quietly. Restructuring, reorganizing, optimizing, all code words for replacing humans with algorithms. And the pace is accelerating. As AI systems get better, faster, and cheaper, the economic incentive to replace workers becomes overwhelming. This isn't slowing down, it's speeding up. So why is this happening? How can the economy grow while jobs disappear? Mohamed El-Erian nailed it when he talked about the decoupling of employment from economic growth. For decades, the relationship was straightforward. When GDP grew, companies needed more workers to produce more goods and services. More output required more labor. It was a direct mechanical relationship. If the economy expanded by 4%, employment would grow, unemployment would fall, wages would rise. The benefits of growth were distributed across the labor market. That's how capitalism was supposed to work. But that relationship is breaking down. And the reason is productivity. Companies have figured out how to produce more with fewer people. AI doesn't just make workers more efficient, it replaces them entirely. A customer service department that used to need 100 people now needs 10 people and a chatbot. A warehouse that used to need 500 workers now needs 50 workers and a fleet of robots. A logistics operation that used to need 200 analysts now needs 20 analysts and a machine learning model. The output is the same or higher. Revenue is the same or higher. Profits are the same or higher. But headcount is down 80 to 90%. In fact, the most profitable companies are the ones shedding workers the fastest. Amazon is worth over $1 trillion. It just announced 16,000 layoffs. Alphabet is planning $185 billion in AI capital expenditures. It's also cutting jobs. These companies are growing. Their revenue is increasing. Their stock prices are soaring, but they're doing it with fewer people every quarter. And this creates a vicious cycle. When companies cut jobs, unemployed workers have less money to spend. Consumer demand weakens. Other companies see weaker demand and cut their own headcount. More job losses, less spending. The cycle reinforces itself. But here's the paradox. Even as consumer demand weakens, corporate profits stay strong because costs are falling faster than revenue. Firing workers saves money. Automation saves money. AI saves money. So profits rise even as the overall economy weakens. GDP can grow even as the labor market collapses. That's the decoupling. And once it starts, it's very hard to stop. And let's break down exactly why GDP is growing at 4.4% while layoffs surge. There are four main drivers. First, AI capital expenditure. Companies are spending mind-boggling amounts of money on AI infrastructure. Google's parent company, Alphabet, just announced it will spend $185 billion on AI in 2026 alone. That's the highest capital expenditure in the company's history. When Alphabet spends $185 billion building data centers, buying chips from NVIDIA, and developing AI models, that counts as economic activity. It shows up in GDP. But here's the problem. That $185 billion doesn't create many jobs. It creates construction jobs while the data centers are being built. It creates some engineering jobs to maintain the systems. But once the AI infrastructure is operational, it replaces far more jobs than it created. The net effect on employment is negative, but the net effect on GDP is massively positive. Second, stock buybacks. Corporate America spent over $800 billion on stock buybacks in 2025. When a company uses its profits to buy back its own shares, that boosts the stock price. Higher stock prices mean wealthier shareholders. Wealthier shareholders spend more money. That spending counts as economic activity in GDP. But stock buybacks don't create jobs. In fact, companies often announce layoffs and buybacks simultaneously. Fire workers to cut costs, use the savings to buy back stock. Shareholders get rich. Workers get fired. GDP grows. Third, consumer spending is still holding up, barely. Americans are draining their savings and running up credit card debt to maintain spending levels. That consumption drives GDP growth in the short term. But it's not sustainable. Once savings are exhausted and credit cards are maxed out, consumer spending will collapse. Fourth, government spending. Federal deficits are massive. The government is pumping money into the economy through infrastructure spending, defense contracts, and various programs. That government spending shows up in GDP. But much of it flows to corporations, not workers. Defense contractors get billion-dollar deals. Tech companies get government AI contracts. The money inflates GDP without creating widespread employment. So GDP grows, corporate profits soar, stock markets hit records. But the average worker sees none of it. The growth is real. It's just not inclusive. Mohamed El-Erian said this decoupling has profound political and social implications. Let's talk about what that means. When economic growth benefits everyone, society is stable, workers see their wages rise, families can afford homes, young people believe they'll have better lives than their parents. That shared prosperity creates political stability and social cohesion. But when growth only benefits the top, everything changes. We're already seeing the early warning signs. Consumer confidence just crashed to 84.5, the lowest level since 2014. People feel terrible about the economy, even though GDP is growing at 4.4%. Why? Because the growth isn't reaching them. Their wages are stagnant, their jobs are disappearing, their cost of living is rising. They see headlines about record corporate profits and stock market highs, but their personal financial situation is getting worse. That creates a disconnect between the data and lived experience. Politicians and economists point to GDP growth and say the economy is strong. Workers look at their bank accounts and say you're lying. That gap breeds distrust. It fuels populism. It creates political volatility, and it gets worse. The workers being displaced aren't finding equivalent jobs. A middle manager at Amazon who gets laid off isn't becoming an AI engineer. They're becoming an Uber driver or a retail worker making a fraction of their old salary. That's downward mobility. And downward mobility breeds resentment. When you go from an $80,000 salary to $35,000 because AI took your job, you're angry. When you see the company that fired you posting record profits and the CEO getting a massive bonus, you're furious. And when politicians tell you the economy is great because GDP is up, you stop trusting the entire system. This is how democracies fracture, not through sudden revolution, but through slow erosion of the social contract. The deal used to be simple. Work hard, follow the rules, and you'll have a decent life. But that deal is breaking. You can work hard and still get replaced by an algorithm. You can follow the rules and still see your job shipped overseas or automated away. And when enough people feel that the system is rigged against them, political chaos follows. The Federal Reserve has a dual mandate: maximum employment and stable prices. They're supposed to balance both. But in 2026, that mandate is becoming impossible. Here's the problem. If the Fed cuts interest rates to stimulate job creation, they risk reigniting inflation. Prices are still elevated. The ISM report showed the prices index at 59%. Inflation expectations are stuck at 4.2%, well above the Fed's 2% target. Lower interest rates would make inflation worse, but if the Fed keeps rates high or raises them further to fight inflation, they'll destroy what's left of the job market. Higher rates make borrowing expensive. Companies cut back on expansion. Hiring freezes deepen. Layoffs accelerate. The 108,435 job cuts in January become 150,000 in February and 200,000 in March. The Fed is trapped. They can fight inflation or they can fight unemployment, but they can't fight both at the same time. And here's what makes it worse. Traditional monetary policy assumes that employment and GDP move together. When the economy grows, jobs follow. So the Fed can focus on managing inflation and trust that employment will take care of itself. But that assumption is dead. GDP is growing at 4.4% while layoffs surge 118%. The old playbook doesn't work anymore. Jerome Powell's term as Fed chair ends in May 2026. Kevin Warsh, Trump's nominee to replace him, is a notorious inflation hawk. He's on record saying the Fed should prioritize price stability over employment. That means if Warsh becomes chair, the Fed will likely keep rates high or even raise them, regardless of what's happening in the labor market. He'll let unemployment rise to crush inflation. And millions of workers will pay the price. But even if Warsh doesn't get confirmed, whoever becomes the next Fed chair faces an impossible situation. Monetary policy is designed for an economy where growth creates jobs. It's not designed for an economy where growth destroys jobs. The tools don't work anymore. Rate cuts won't create jobs if companies prefer AI over workers. Rate hikes won't help workers if they're already getting fired. The Fed is powerless, and they know it. So what do you do when GDP grows but jobs disappear? When the economy looks strong on paper but you're getting fired in reality? When politicians celebrate growth that doesn't reach you? First, stop trusting the headline GDP numbers. A 4.4% growth rate means nothing if you're one of the 435 people who lost their job in January. The economy can be growing for corporations and investors while collapsing for workers. Those are two different economies, and you need to understand which one you're living in. Second, secure your job right now. If you're employed, this is not the time to coast. Make yourself indispensable. Take on critical projects. Document your value. Build relationships with decision makers. 52% of companies expect more layoffs in 2026. If your company is in that majority, you need to be in the group they can't afford to lose. If you see the warning signs, hiring freezes, budget cuts, talk of efficiency, start looking for a new job immediately. Don't wait for the layoff announcement. Third, build a 12-month emergency fund, not 6 months. 12. In this decoupled economy where hiring plans are at 2009 levels, it could take a year to find a comparable job after a layoff. You need runway. Cut unnecessary expenses now. Build that cash cushion while you still have income. Fourth, upskill or get replaced. AI job postings are up 130%, but traditional jobs are vanishing. You don't need to become an AI engineer, but you need to understand how AI impacts your industry and learn to work alongside it. Take courses, get certifications, make yourself AI adjacent, not AI replaceable. Fifth, prepare for the political and social chaos that's coming. When GDP grows but workers suffer, trust in institutions collapses. Political volatility increases, social tension rises. Diversify your income sources. Reduce your dependence on any single employer or any single system. And if you haven't watched our previous videos on consumer confidence crashing to 84.5, manufacturing expanding while firing workers, and Bitcoin's 40% collapse, go watch them now. They're all connected. The economy is decoupling. Growth no longer means jobs. And if you don't see it coming, you'll be the next casualty.